Your grandfather walked into the local bank and borrowed money at 4%, shook hands with the banker who knew his name, knew his land, knew his family had farmed that ground for 30 years. You borrow at 8% from a lender whose regional office is 2 states away, who has never seen your farm, who approves your loan based on a credit score, a debt-to-asset ratio, and a commodity price projection built by an economist who has never planted a row of anything. 4%, 8%, same land, same risk, same spring when the money has to be in the ground before the crop can go in. When you double the cost of borrowing to do the same thing your grandfather did for half the rate. In 1965, your grandfather borrowed operating capital at 3 to 5%. Land loans ran 4 to 6%. And equipment financing came from the local bank or the implement dealer at rates that reflected what the Federal Reserve was doing and what the local banker thought of your family's 30-year relationship with that institution. The relationship mattered, not sentimentally, practically. A banker who knew your grandfather's operation could evaluate risk that a credit score cannot capture. Well, he knew which years were drought years and which years your grandfather made his payments early. That knowledge affected the rate favorably. If old iron runs in your blood, subscribe to classic farm iron. Fellow farmers are watching right now. Three forces drove farm borrowing from 4% to 8% and changed the relationship between farmers and credit permanently. Consolidation of agricultural lending, the end of relationship banking, the increasing cost structure that made borrowing not a choice but a requirement. Each force made credit more expensive. Each force made the farmer more dependent on institutions that understood spreadsheets better than soil. And each force moved farming further from the model your grandfather used, where credit was a tool you chose to use toward one you could not farm without. Consolidation first. Your grandfather's county had a local bank that understood agriculture. The bank president had grown up in the same county. His family may have farmed. At minimum, he had watched farming through decades of good years and bad ones. He understood that a farm loan in March might look different in November, depending on what August brought. That understanding informed how he lent. He could extend a line of credit on a handshake in a drought year because he had watched the same family make good on their obligations through 3 previous drought years. The relationship was the collateral as much as the land. In 1980, there were more than 14,000 commercial banks in the United States. Most were community institutions. The most agricultural lending that happened at the local level. The banker knew the farmer. Today, there are fewer than 5,000 commercial banks. The top 4 banks control more than 40% of all banking assets. Agricultural lending has consolidated into farm credit institutions, large regional banks, and the Farm Service Agency, each with its own approval process and its own credit scoring system, its own risk model built for scale, not for the specific circumstances of your specific operation in your specific county. The local bank that knew your grandfather was acquired by a regional bank in 1987. That regional bank was acquired by a national institution in 2001. The building still says bank on the front. The decisions are made somewhere else. Relationship banking second. Your grandfather's banker evaluated his loan application differently than yours is evaluated, not less rigorously, differently. He looked at the land, he looked at the equipment, he looked at the yields over the past decade, he looked at how the family had handled the bad years. He made a judgment based on knowledge that existed outside any spreadsheet, and that judgment could go in the farmer's favor in ways that a credit algorithm is not designed to replicate. Your loan application goes into a system, your credit score is pulled, your debt-to-asset ratio is calculated, your working capital is measured against benchmarks built on industry averages. No, the commodity price used to project your repayment capacity was set by a futures market in Chicago. The person reviewing your application may have a strong understanding of agricultural finance. They may never have seen a cornfield. The Farm Credit System was created in 1916 specifically to serve agricultural borrowers at fair rates. It operates today as a network of cooperatively owned institutions that provide roughly 40% of all farm lending in the United States. The rates are competitive. The terms are designed for agriculture. The system serves a genuine purpose. And yet, the Farm Credit System in 2024 is a large financial institution operating at scale. Its loan officers cover territories your grandfather's banker never would have been asked to cover. Its approval processes involve documentation requirements that would have seemed extraordinary to the man who lent your grandfather money on the strength of 30 years of kept promises. Interest rate history tells part of the story directly. From 1950 to 1972, the prime lending rate ranged from 2.5% to 6%. Farm loans tracked at or below prime. Your grandfather borrowed in an era of genuinely low rates that reflected Federal Reserve policy designed for a growing post-war economy. Then came the 1970s. Inflation, oil shocks. The Federal Reserve under Paul Volcker raised rates dramatically to break inflation. By 1981, the prime rate reached 21.5%. Farm loan rates followed prime upward. Farmers who had borrowed at 6% to buy land at $10,000 an acre found themselves refinancing at 16% as land values collapsed below their loan balances. This is where the farm crisis of the 1980s began. In the gap between the rate they borrowed at and the rate the market demanded when their notes came due. Rates came down through the 1990s and 2000s. The Federal Reserve cut rates to near zero after 2008. Farm lending rates dropped accordingly. The era of cheap money lasted from 2009 to 2022. Then inflation returned. The Federal Reserve raised rates from near zero to over 5% in 14 months, the fastest rate increase in 40 years. Farm loan rates moved from 3.5% to 7 and 8% in the same period. Operating loans that cost $12,000 in interest in 2021 cost $28,000 in interest in 2023 on the same principle for the same farm. The cost structure third. Your grandfather borrowed money as a choice. He borrowed when the opportunity justified the cost. When land became available at a price worth financing. When equipment needs exceeded cash on hand, he ran some years without any operating debt at all. The cash from last year's harvest covered this year's inputs. The margin existed to allow it. You borrow because the cost structure of modern farming requires it. Seed, fertilizer, chemicals, fuel, insurance, land rent, all of it due in spring before a single kernel goes in the ground, before a single bushel can be sold to pay for any of it. The operating loan is not optional. But that is the mechanism that bridges spring inputs and fall income. Your grandfather used it occasionally, you use it every year without exception. And at 8%, the bridge costs significantly more than it cost him at 4%. The financial math makes the difference concrete. Your grandfather financed a 500-acre corn operation with a spring operating loan of approximately $30,000 in 1965. At 4% for 6 months, his interest cost was $600, a manageable cost against a harvest that returned reasonable margins. Your spring operating loan for 500 acres runs approximately $300,000. Seed, fertilizer, chemicals, fuel, insurance, years, land rent. At 8% for 6 months, your interest cost is $12,000. Before you sell a single bushel, $600, $12,000, same 6 months. And same crop in the ground, same prayer that the rain comes right and the price holds. 20 times the interest cost for the same season of the same farming. Some farmers found ways to reduce their credit dependency. Cash flow management, timing input purchases to take advantage of early payment discounts, reducing the principal that accumulates interest by shortening the borrowing window. Small efficiency, real savings, on-farm input storage, buying fertilizer in fall when prices are lower, reducing the amount borrowed in spring when rates are high and input costs are peak, requires capital for storage. It saves on both input cost and interest cost. Direct lender relationships, finding the farm credit institution or community bank that still employs a loan officer with agricultural knowledge. The relationship still matters where it still exists. It exists in fewer places than it used to, but it exists, off-farm income. The uncomfortable reality that the majority of farm household income in America now comes from off-farm sources. Not because farmers don't want to farm full-time, because the margin between input costs and commodity prices often doesn't support a family without a second income stream. Your grandfather didn't need a second job. Most farmers today do. But your grandfather walked into the local bank in March. The banker knew his name, knew his land, knew that the drought of 1957 hadn't stopped him from making his payment by November. That knowledge was worth something in the rate. 4%, $600 of interest for a season of farming. What, you complete your loan application online or in an office with someone who is evaluating a debt-to-asset ratio and a credit score and a commodity price projection built in Chicago. 8%, $12,000 of interest for the same season of the same farming. On land your grandfather would recognize, for a crop that still weighs 56 pounds a bushel. Only 4%, 8%, same farm, same risk, different system deciding what your promise is worth. What rate did your grandfather borrow at? Do you know the number? Did he ever talk about the banker who understood his operation? Well, do you remember the first year the operating loan felt less like a tool and more like a requirement? The first year the interest cost was large enough to notice in the final numbers? Is there a banker in your county who still understands what it actually means to farm through a bad year? Or has that knowledge left the building, along with the community bank that used to occupy it? Tell us below. Because the farmers who remember 4% in a handshake understand something about 8% in a credit algorithm that no loan officer 3 states away will ever fully appreciate. And to share this with a farmer who fills out an operating loan application every March and wonders what it felt like when the man who approved the loan had driven past the field the money was going into.